If you can't raise $100,000, you're not ready for $1 million. I'm talking about raising capital. It's a mindset here. If you don't have the ability to raise $100,000, which should be pretty easy once you learn how to raise capital, how are you supposed to raise $1 million? How are you supposed to raise $10 million? How are you supposed to raise $1 billion? It's not going to happen. You need to learn how to raise capital with low amounts in the beginning, and then you can work your way up. Now, it's a mindset thing. So at the end of the day, you got to ask yourself why you can't raise $100,000. It should be simple. Is it your network? Is it your product? Is it you? Most likely it's you for some reason because you're in charge of choosing the product. You're in charge of building the network, right? There is money out there everywhere in every market condition. There's no excuse why you cannot raise $100,000. So why don't you try this out right now? If you're watching this video, who do you know with $100,000? What product are you selling? Or is it you? Did you do something? I don't know about you. What did you do? What is it about you? Believe me, most of the time it's about you, right? And it starts very simple with me. You need to develop the skills to be successful, to learn how to raise capital. I've been raising capital for decades, over 30 years. Don't like saying that, it gives away my age. I have repetition. I have Malcolm Gladwell's 10,000 hours. I most likely have 100,000 hours of raising capital. And I've raised capital during different market cycles. Today is a different market cycle than before. If you want to hide behind a computer and do a lot of ads, do cold email outreach, and you go, I can't raise $100,000, it might be your approach. Because at the end of the day, it's not your product, it's you they're buying into. And it's a mindset. So again, I think it doesn't depend upon your age. You could be old, you could be young, you could be right in the middle, you could have experience, you could have no experience, you still have the ability to raise capital. You don't have to get a certification. You don't have to go to school. You don't need an MBA. You don't need a PhD. You don't need to pass all these securities exams to raise capital for your own venture at the end of the day. So there might be a stigma out there that you can't do it, but it's really a mindset at the end of the day. It's getting that mindset and learning how to raise capital, right? Okay, now let's talk about the product. What if it's the product? You have a shitty product. No one's going to buy a shitty product. If you have delusions of grandeur about, hey, this product's going to change the world. Well, we got to talk about, okay, is this a product? Do your research on the product. Hey, I'm going to sell a product that's going to ship books to everyone. Hello, Amazon, you cannot kind of copy someone else has been out there. And then you have to look at the market. Who's your addressable market? A lot of us go, hey, this is going to go viral. It's going to go global. Here's all the people going to use the product. This is kind of have to do your research here. You're going to have to understand your numbers. You have to understand your competition. Your competition could have a better network. They could have a better go-to-market strategy. They could have a better distribution strategy. You're going to have to really do your research here. How do you stand out? Watch Shark Tank. That's a great idea. I've seen all these companies with great ideas, and they shoot some down and some they really like. So study the ones they really like. In some cases, they really like them. They're arguing with each other. Those are the ones that have something about them that they believe is going to take off or that fits their distribution channel. So I think it's more about what fits their distribution channel with their networks than anything else. This is my opinion. And you can see them kind of argue over the sure things together. So also about raising capital. It is a lot about the product. Do your research and know your numbers. It's about you. So if you ask a question or they ask a question and you don't know your numbers, right? They're going to be like, wow, this person, how am I supposed to give this person money if they can't answer the question directly? You can't screw around it. They will ask you a question. You need to have the answers. Know your numbers. Know your shit. Call that ownership. Own it. Study it. Memorize it. First impressions mean a lot when you're raising capital. Serious investors don't have a lot of time to waste. They're getting approached by everybody. So if you're reaching out to them, you have that shot there. You are gonna have to know your numbers. Give them direct answers. If you don't have all the answers, you tell them right away, I don't have the answer there. And hopefully that's not something that's gonna kill the deal and something that you don't have the answer for a good reason, but it's better be honest up front than be like, well. You start doing that. That trust evades because it's all about building trust that investor. And if they could find an excuse not to do the deal, they're not going to do the deal. So a lot of raising capital is on mindset. You're going in, right? You're going in, you're raising capital. So kind of get loose, got to get that confidence going, that flow. It is such a mindset. You have to have the utmost confidence in yourself, right? So first of all, confidence in your voice, how you're talking to this person. You have to exude confidence. They're invested in you, not just your product, right? So you have to say, why would this person give me the money? Really ask that question. Why would they give you their hard-earned money? You better be able to answer that to yourself, right? Going in with that, and then that's kind of knowing your shit and answering all the questions. So you're going to either convince yourself or get up some good answers there, really work on that. And as you do that the confidence comes out. And it's a mindset too. So what I look at, you're also going to have to understand that when you're approaching them with confidence here is that they're investing in you, not your product. And I think the most important thing is you're giving them an opportunity. Shift it. Shift that mental mindset. Whatever kind of words you put in your own brain, that's usually what gets in the way here. Again, mindset. It's like, look, this is just an opportunity. It's just a conversation. Hey, I have this product I'm selling. Hey, I have this investment opportunity. Maybe it's something with real estate. Let me show you an opportunity for you to make some returns by you sitting home all day and me doing the work with my team to produce a result for you. And at the same time, I get something for myself. So you always have to understand you got to structure it in a way how you're going to get something for yourself. Structuring deals, I could go into that later. Love structuring deals, been structuring that across my lifetime. We'll get into that. But if you get a really good deal at the end of the day, if you get a really good deal, understand that you're giving someone an opportunity here. You're not going, can I get some money? It's like, hey, I got this great opportunity here. Wondering if you're interested into it. Before we begin, it's about a $100,000 investment. It's something that's going to be 3 years. This might be a longer term hold. This might be a short term investment. Are you interested? Great. Love to grab a cup of coffee. Love to jump on the phone. Love to jump on a Zoom meeting. Whatever it is you could do. Nowadays, you can do things globally, which is great. If you're going to do stuff outside the U.S., I know there's kind of some things to do with securities there. So again, you could DM me capital, and I could help you out with every situation, every scenario. With this much experience, you say, hey, close to 100,000 hours of doing this. I've done things internationally, locally, institutionally, retail, you name it. I've done it, and I'm still learning. I'm still learning. So it's a lifelong thing. I actually enjoy raising capital, and I really more enjoy teaching people how to raise capital. One of the things about raising capital, there's a lot of nuances. How much, who you're getting it from, investor selection is very, very important. Choosing the right investor. Trust me on this one. I've had the right investors. I've had the wrong investors. The wrong investors are a headache. It's better to walk away from the deal than take dumb money. And here's a story. This didn't happen to me. This happened to somebody else. They got some money for their company, and it was external. I believe it was China. And every Sunday night, their CFO, or their finance person in this case, is called it a CFO. It's a small company. I'm not sure if you're CFO of 5 people, but they were a CFO. They would have to create this report that this woman told me took them 8 hours to prepare to go over the financials of the company on a weekly basis. So every Sunday, she's putting this huge report together. Well, how the hell are you supposed to operate your company if you're consistently just giving people reports? Now, that's a overbearing investor. That's kind of like the helicopter mother you hear about, a helicopter investor. So maybe call it now a new word. We'll call it the drone investor. You don't want that type of investor. You need someone who's going to kind of give you the space and the support to be successful. Investors are like Forrest Gump. They're like a box of chocolates. You never know what you're going to get. You should twist the interview around to them instead of you going and pitching. Maybe you're going to them and saying, hey, what type of investor are you? Are you a passive investor? Do you someone want weekly updates, daily updates? Nowadays, everyone's watching Robinhood and seeing crypto go up and down, up and down. There is this kind of mentality out there that we need to check our investment on a daily basis. So people want apps and push notifications. It's like, okay, that is cool and everything, but if you're just starting out or have a small operation, let's say you're just under 100 people, because that's 100, it's not a huge company, and you want all these bells and whistles, that's going to be tough to do. However, day and age of AI will help us out to give those tools, but you see what I'm getting at here. Even with AI, you got to go out and you got to build an app for someone, and you have small investors, not a lot of investors, and it's like, hey, could we just do a quarterly update? Could we do a Zoom call? And I'm going to roll that into that Zoom call thing again, because I think being transparent is real. I really do in today's day and age, in 2026. I think you need to put a face on your business. You got to be the brand. So you need to have transparent communication, good or bad news. I had to give bad news to a group of investors. Well, I'm not sure if it was bad news. It wasn't bad news for me. I had to give them news. Let's just call it. So I had to do a Zoom meeting. I did about, I don't know, anywhere from 6 to 8 Zoom meetings, the group about 200 people. And I had to give them news that they didn't think was in their best interest. It didn't benefit them. And I got right in front of it. I said, hey, first of all, I want to thank everyone for being here. And I take full accountability for everything I'm going to share with you. I just, right off the bat, I take accountability. This didn't go according to plan. I really believe this wasn't something that I take accountability again. I said that I agreed to, and so I had to step in with some of my governance here, and we have to change some things here. So this is not going to be good for all of you here. And yeah, most it went over well. Some people are still probably a little bit pissed off because people are people, and I understand that. You can't like everybody's not going to like you. Who was it? Robert Kiyosaki, who said a third of people are going to like you, a third of people that hate you, and a third of people who don't know anything about you. So you're going to have to build that type of mentality. And they only can do that through repetition. So one of the keys about raising capital, are you able to overcome rejection 1,000 times? If you're soft, you might want to find someone else who could help you out here, but I don't know. I think that's if you can't overcome rejection, you should probably not be a business owner, because you know how many things don't go according to plan. When you're running a business, you should just get that W-2 job. And there's some types of people out there, and I could go into a story and a rabbit hole here, but there is what I've doing some asset selection or find an investment, and a distressed investment. Sometimes I look at the mentality of who owns that investment, and I could tell these guys are more wired for things to go perfect. Engineers is one thing. I might look for an engineer who did a multifamily project. I bought a couple off of them because things didn't go according to plan. They're like, okay, I got to check all these boxes. Things never go according to plan. And they were like stressed out, and they were able to, they discounted the asset for us to purchase. But you look at that. You look at these behaviors of people who shouldn't be in business. So I wouldn't give someone like that money to invest in. I want someone who's going to be, rock hard, be able to tackle problems, dive into it and solve it, and show me some type of track record or experience of them really solving problems and everything. And you could do that. You could dig into it and get to know people with that. And online, kind of watch out for things. That's why I like the Zoom meetings. I want to be in front of a person. I want to see their face. I want to see their reaction when I ask a question. I like the backdoor questions, like go off the cuff and not your normal questions, just see the reaction of the person. I want to see something about them, whether how they grew up or what they did earlier in life, how they got to where they were today. I really want to know this person's story. I want to know what motivates them. And this is good. I'm asking you questions right now of what I would do, right? If I was interviewing you, right? If it was my money invested in your project. So same thing, right? So you might get these questions as well. So just prepare for them. But again, let's go back into the dumb investor. When you're going to work with the retail investor, there is a limitless supply of them. Limitless. So it's okay to say no to somebody. You don't have to get money from everybody. That's, of course, you might have to ask 1,000 people to get the right one, and that's okay. Nowadays, we have all these tools to do it. And like it or not, you're going to have to put yourself out there. Now, I talked about Zoom, but that's social media. You're going to have to build a profile. They'll do research on you. That's good. There'll be good things about you. There'll be bad things about you. Maybe you did something stupid in high school and someone put something online. It's going to happen. But really, the professional investors will go through that noise, and they will give you that opportunity to have that presentation to them. You just got to get out there and put yourself online, talk about yourself, brag about yourself. That's not the easiest thing to do in the world. I had a little difficulty in the beginning bragging about myself. And just yesterday I was on a call with somebody. I was like, oh, by the way, I forgot. I raised money for a nonprofit organization for 4 years. It wasn't just about raising money for businesses or venture or real estate or crowdfunding, but I actually worked for a charity for 4 years from age 30 to 34. It was a great charity called Arts. And one of our art students, these gentlemen came over and said, we'd like to film a documentary on her. And lo and behold, it won an Academy Award. So I was pretty excited about that. And I feel so grateful to have that opportunity to work with them. It's a heartbreaker of a story. It's called Innocente. Check it out. And yeah, when you kind of, you always forget your things. And I'm talking about this because I don't have that anywhere. I don't have that online. I'm like, wait a second, I worked for a charity for 4 years. So I'm not just this gruff, masculine type A guy. At the same time, I've always done charity work, and I've done charity work way back into the days of my upbringing in high school where they required us to do charity work. I remember my junior year in high school, I had 40 hours a year of charity work. My senior year, I had to do 2 hours a week to graduate. So it was always something. When I was in college, I did stuff with groups and organizations, and we took kids from the inner city and showed them around Boulder, Colorado. So I've always kind of done something when it comes to charity my entire life. And maybe that's why I'm kind of sharing my experiences right now, because I really get that satisfaction when I'm giving back to people. It's something that was ingrained to me. So it's just not about raising capital and making money, which we all should do. It's our American right, I believe. This is an American dream. We have that ability to go up the wealth ladder. Now, a lot of people say the American dream is home ownership or this, rights of freedom of expression, due process, all those things. But for me, the American dream is the ability to go up the wealth ladder, where it's the easiest in this country than anywhere else in the world. That's why people, they might hate the country, but they all come here because they know that. They know it's easier to make money and go from this station to this station than anywhere else. Globally, it's starting to be easier. However, I haven't lived in a lot of different countries. It's just this country, it is the easiest to do it. And that's the American dream here, the ability to go up the wealth ladder. That's why we don't like to be taxed. That's why we don't like to be controlled and all these things. And that's why you see all these people we got to remember that. We got to remember why we're here. Yes, these freedoms, this equality, but the ability for us to prosper, right? So that's why we're all here. Anyway, get back on subject here is about raising capital. Love raising capital. It's been something that, I've been doing since the late 90s. I was fortunate to meet a couple mentors in early age. And also, I lived in a couple different parts of the country. I lived in Fairfield County. If you know Fairfield County, it's outside New York. It was a middle-class family, so I wasn't like one of the ones with the huge mansions out there that you kind of read about in the hedge fund managers. But I did go to a good private school out there, and my parents did a good job of working extremely hard to stick me into a private school, so I developed those skills and was around a lot of wealthy kids. One of the kids' father was president of NBC back in the day, and I think NBC owned what's that company? Was it? I think it was IBM. IBM headquarters was out there too, as well. So I remember going over to his house. He had all these. I don't know, General Electric. Sorry, it was GE. And he'd always have all these appliances all over his house. It's pretty cool. He had a good upbringing. His dad was pretty chill. He didn't really made him work pretty hard. So that was kind of nice. He wasn't handed stuff, but it was nice to be around like people in that culture. And then from there, I moved out to Boulder, Colorado. And then from there, I moved to La Jolla, California. You could say I lived in all these areas where there were wealthy people, but that was done with intent. I knew I was going to go after college, go to an area where I can learn around people who built businesses and were wealthy so I could learn how that world worked. So I immersed myself into it and I started to develop the skills that I didn't have so I could build wealth, learn how to be an entrepreneur. I think one of the biggest decisions was, should I go back and get an MBA in a school of business? And then right away I started making $100,000 a year doing some side jobs in the late 90s. And then I was able to get that a little higher and higher real quickly. And I was like, oh, I don't need to go back. I'm learning so much from just being around all these business owners. And then when the skills started learning, it's like, hey, how do you raise capital? And I got exposed to some things. You could say I was exposed to like the godfather of this guy who built out all these real estate hedge funds in town. He passed away years ago. Of course, I'm in my early 50s. They're not around the guys I learned to in my early 20s nowadays. And that's something too. So like you'll get investors and then you need new investors because when I was in my 20s and 30s, I had investors in their 70s or 60s, 70s, no longer around with us. Or they're kind of in that position in life where not proactively investing. And so you have to always kind of, get new investors, right? Market shift. So after the 2008 crash, what happened? I'm calling up investors nonstop. It's like, hey, got these great opportunities, got this great idea, this product. Let's do the numbers. Look, it's fantastic. Like, I'm sorry, Craig, I lost my money. Or someone would say, hey, I invested money in these bad projects. And it's not just they didn't have money. So I'll go to someone who had money and they're like, hey, you know what? I have money, but I lost money in this downturn and I just don't want to invest right now. So he's got these two things, people who have lost money. And then you have that mindset, that psychology, that human behavior. Really, you have to study a lot of human behavior here of people losing money in that time period. And they're like, whoa, I'm not going to touch anything. Third is when you do get the money, they underwrite it. They overanalyze it. So now three things are against you in a down cycle. It's like, geez, one, like people lost money. I was like, great. A lot of my investors lost money, a large portion. Number two would be, hey, it's just they have such a negative conception of investing right now because of everyone around them losing money. And three, if they do have it, hey, they're over analyzing it. And four, we always talk about four, is they start believing, hey, they have the money and they want to dictate terms that are really good for them. And that's a trick. That's what the wealthy do. They know I have liquidity and you don't, you need it. So I'm gonna make those terms so good for myself. That's why they make so much money in downturns. Those who are liquid make the most money. Again, let's get back to mindset. But if you know you have a great deal, there's enough people out there to fund you. And so you just got to hold on tight and say, nope, these are my terms. You got to go the next. And how do you do that? You need the money for your project, right? I need to raise, again, if you can't raise $100,000, hey, shouldn't be doing this. This should be easy. No fear. Let's say I had to raise $1 million in 30 days. What do? Right? You got to approach it and you don't want to be needy, right? You don't want to be needy about it. It's like, oh, I really need this. Or get the terms like, hey, here's these terms that are going to hurt you in the long run. So again, it's structuring. It's actually structuring terms and nothing. It's not just structuring a deal. If I'm going to put this in the LLC, an S Corp, Wyoming, Nevada, Delaware, whatever that is, that's structuring waterfalls and all that stuff. But it's more is how you're going to structure in a way where you can make money on this deal. If you have a great deal, you want to structure in a way where you benefit. So some of the ways I've done that in the last downturn is I used to do stuff and it was an equity share. And then I was like, okay, at first I was like, okay, let me give away a little bit more to prove concept and then make the equity split a little bit more kind to myself. And then with time, I'm like, hey, let me try this and let me just do a line of credit with some guys. And I just said, hey, let's fund into an entity and let's just set it up and put it in the paperwork that it's just a line of credit that I get to pull off of. And every time I pull off of it, you get a return on it. And then I was benefiting more because I was getting more upside and they lost the risk of the downside of it kind of going, less of a return than it was. Sometimes equity deals don't go according to plan. It worked for both parties there. And I made a lot of money doing it that way. I had a couple home runs off of that. And then as soon as the market kind of started accelerating, I just refinanced their money out. All they had to do was pay interest. And here I am owning all these assets without any partners, limited partners, just by myself. And so that's something that I see in this market today. I could buy discounted assets. And why should I do like an equity split when I could do something where I could do something with private credit? And that's kind of one of the products that I'm really big into selling this year and next year is private credit because the banks aren't that liquid, right? The major institutional players are gobbling stuff up. The terms are really in their favor. So if you had access to private credit, or in my case, we do some private credit things, then that's the way I would kind of structure my deals with private credit and give those opportunities, especially to people who just got kind of burned or people who have their money really locked up and they don't really want to have their money locked up. I think a lot of people are playing the market this last cycle and saw how quickly companies were turning. You start a company, you flip it to a larger company, you buy an asset, you flip it to an institutional investor. All these things were happening so quickly. You buy something, it's accelerating price, I could refinance it out to my LPs. And that just kind of stopped. And now you're kind of stuck with the asset and it's could be an illiquid asset. Was it BlackRock the other day wasn't sure BlackRock or Blackstone. Don't get me, not sure if I misquote myself here, but let's just say they're having a run on capital and they had to stop their capital calls because people wanted to liquefy out of their funds because one reason is because of fear, right? Always fear drives it. I want to pull the money in. But number two, people want that money out so they could have that dry powder, that money so they could buy distressed assets. They don't really say it when someone puts an article out there. And, people are always creating a narrative at the end of the day, but these guys at BlackRock kind of rule the world. They've got tens of trillions of dollars out there. They know what they're doing at the end of the day. They're making returns, and they're always kind of ahead of the game. But let's get back to raising capital. It's a mindset. I even developed commandments in how to raise capital. Let's get back to you at the end of the day. You want to learn how to raise capital. Why do you want to learn how to raise capital? Well, it's a good question. So really, where are you? Building a company. I want to get bigger faster. Really, I'm raising capital so I could do more, make more money, make more revenue, do more things, leverage myself. So this is a skill set that if you really want to build a large company or buy like a large asset that you will need to develop. Everyone needs to develop this skill. The number one rule I have the capital raising, well, let's call it number two. Number one's always you have to have confidence. But one of the biggest rules is you having that skill is raising capital when you don't need it. So when you do need it, you have those relationships in place. You could just get on the phone and call somebody. You could text them, and then they could pick it up, and then then it's easier to get. So if you kind of go and just go, shit, I need it now, and I got a 30-day window, 60, 90, whatever, purchase an asset, that's a little bit more difficult to do. So it's always, hey, it's a skill I am going to develop and put that in my arsenal as an entrepreneur, as a business owner, as an investor, where I'm going to have a pool of people always close by my side or a mechanism to raise capital when I need it. Now, if you're in a business where let's say in real estate and you need LPs to go that next level, and you're constantly have to raise capital all the time to really, do more deals, because maybe you're doing one deal or two deals, your own stuff, you want to go to 3 to 5, that's a skill set you'll need to acquire with time. And I know I've raised capital from so many people. And one of the things is like, hey, by doing that is just the experiences I have, the different conversations I have, the different ways to structure deals I've had. I worked with FINRA, the SEC, you name the government organization, I've worked with that, worked with expensive attorneys, cheap attorneys. At the end of the day, if you do a deal, you tell someone you're going to do something, you tell them, right? Well, you tell them and you put in the paperwork. Let's talk about this. The paperwork is legalities, right? It is there to protect you from a legal point of view. But we live in a world where there's a lot of online stuff. So legally, it will say this, but you still need to be transparent. And what I mean transparent is when you're first acquiring that capital, when you're first pitching that person, make sure those two things match at the end of the day, that you're being transparent, talking about the risk, talking about everything, and then your paperwork matches that. You do that, you'll be fine, right, at the end of the day. And investor suitability is a big thing, and that's like, hey, what percentage of someone's net worth should be in any specific deal? A lot of people go on the 10% rule, 10% of your net worth in any deal. Or liquidable net worth, let's call it liquidable net worth, not your house, outside your house, right? So it means something you can liquidate in 30 days or less should go into an investment opportunity. I like the 5% rule. So it's 1 out of 20. So if I have money in stocks and treasuries, I'll include my IRA there because it's a self-directed and it's $1 million, right? And then maybe I should stick $50,000 in this investment. That's 1/20th. And hey, I could do like an asset class. I could put 20% in an asset class, right? But I would probably do it across maybe four different offerings, right? Just to from a diversification point of view. I mean, that's how I would do it. And at the same time, I'm going to do aggressive stuff. That's okay. But with my aggressive stuff, maybe it's 10%. Depending on where I am in life, when I was younger, it's like 100%. All young people want to be aggressive all the time. We have no fear. But when you're talking to investors, right, they're a little bit more savvy. So if you're talking to someone and you're trying to get $100,000 from them, and they have $100,000 in their bank account, most likely it's not going to happen. I had a guy in my office. He's trying to, oh, this guy's gonna give us $2 million. Great. I was like, well, why don't you just start with 200,000 and just go to him? Hey, let's start small. See if this relationship works. You like our communication, how we handle the process, and then from there, if you like everything, then maybe invest more. It's just a simple approach, right? Everyone's, oh, 2 million, that's a lot of money. But hey, if you're doing this in a manner where you want to be successful at it and have a process in place, a system in place, you might want to take that person and build that relationship over time. And if he likes everything you're doing, whatever you say, you do, whether it's communication or a dividend or whatever it is, you do it, you build that trust up with that individual, and you can always go back for more and more. That risk of having one person with that $2 million and you need to raise $2 million is too high. So if I needed $2 million, right, I'm going to go into, okay, so I'll go up to 10% here because in case you go to 10%, is okay. So can I get that from 10 people that have $2 million net worth, liquidable net worth? So if I could have that and I'm talking to them that, and of course, I always say, hey, I could close like 1 out of 2 people. If you're new, probably 20%, 30%. So maybe 1 out of 3 people. Let's be a little aggressive here. So I would say, okay, do I know 20 people, $2 million that they have that are liquidable? And I'd reach out to them with the project. If they're all liquid, good likely chance I'm going to raise that $2 million. So because I'm not going to ask for too much. And granted, sometimes someone will go, oh, I'm loving this deal, I want to stick more in there. But those are the exceptions. So, and you can't run a business on exceptions. You always hear this one great story, this one great capital raise. Well, I've had a lot of stories that came down the wire, and you know what? Those aren't good stories because that capital was expensive, and those terms were not the terms I wanted. And then, oh shit, the project didn't go the way I wanted to, and now I have all this interest I have to pay and all these profits I have to pay, and I'm not keeping anything for myself. That's a horrible experience. That's going to happen to you if you're desperate for the money. That's why if I were you, I would learn how to raise capital for during times when I don't need it and build that muscle up, build that skill set up. I love talking about raising capital. Again, if you can't raise $100,000, you have no business in trying to get $1 million. If you want to learn more about raising capital, DM me. Just DM my social media, DM Capital. I'll reach out to you. This will be on my YouTube channel. I'll spread some cuts of this across my other social media channels. I really enjoy raising capital. I enjoy more enjoyment out of teaching people how to raise capital. Now, I came out with the commandments of raising capital. Hey, they're not buying your product, they're buying from you. You're not selling to someone, you're offering someone opportunity. You have to overcome rejection 1,000 times. Granted, you want to kind of lower that rejection, but here we are in a new market cycle. So it's like, okay, I'm going back to my investors. Well, 30 years, Craig. I'm like, yeah, but the guys in my 20s and 30s, you know what? They're not around anymore. Or they're older and they're just kind of like, hey, I'm just living off my income. I don't want to do anything anymore. So I'm like, okay, so who am I going to raise capital today? What's my product today? Oh my God. A lot of people got burned. There's a lot of platforms out there that blew up. You know, there's a whole tech revolution's gone. Now we're in this new AI thing. People are sticking money into it. People are like, oh yeah, money's just coming in. Okay. Who are you sitting next to who is raising money in this market? Right? I am a little bit. But how? Well, like anything else, I have experience. So my experience tells me is the guys who invested in 2020 to 2023 were getting some good returns and things were going well, but then some got losses. So I started talking to some of these guys and it's kind of like, wow, I'm talking this many people, right? It's like an iceberg. You see 10%, 90% below. That means 10. To me, that's 10x. That means, Jesus, there's a lot of people in the market that have had a negative experience. So not just talking about losing money, negative experience. And so their mindset's different. They're going to be a little bit more cautious. So first of all, I'm going to have to reach out to 10 times more people. That's the first thing. I'm also going to have to reconstitute or recalibrate, change my strategy here of like who I'm reaching out to. So I'm going to go and call that that executive that I used before to finance stuff. Well, maybe they're nervous about losing a job because of AI. They're not going to, maybe they didn't get a bonus this year. Okay. And where was I finding them? I was on LinkedIn. I was just scraping CEOs and other executives of corporations. Now they're like, I was going looking at tech guys. Well, now they're not moving. Okay. Where should I go? What should I do? Who's actually making money in today's market they need to deploy? I have to think deeper. Okay, maybe this criteria, someone who works in this industry. So I got to go find myself a whole new cohort of people. And everyone's like, oh, crypto people. Well, crypto. So when it's up in the hundreds, right? Yeah, I'm always like, hey, you should move your crypto out before it drops. Well, it dropped, right? Now everyone's like, oh shit, I should have listened to you. It was going up and up and up. Well, maybe you didn't do a good job of pitching that because that's where people were. So now you're gonna go back to them. Last week I was talking to someone. And they're like, hey, my crypto dropped too much. I'm gonna hold on. I want to wait till it to come back. So maybe you lost the opportunity with that cohort right there. So you got to figure out what persona is actually spending money besides institutions, right? We're talking about retail capital here. Institutions, by all means, go to institutions. The terms are going to suck. The terms are not going to be good. I know for me, with my stuff, I'm getting good deals on it, and I ain't putting money into anything that's on the cusp. It's got to be a great deal. And I'm talking like 20, 30% IRR as a good deal right now. And that's what I'd expect. So if you're going to somebody, who you going to and who has that capital. A lot of things there. And structuring. If you want to learn more about structuring deals, what works for you and that other party, DM me capital. I'll give you some pointers there and how that works. In this time period, you got to kind of understand who you're talking to, again, whether their experience is. But again, if you're trying to raise a couple $1,000,000 and you're trying to get 100,000 from 20 guys or 20 people, you got to have to structure it, have a general structure in there where you could, where it meets kind of everybody's needs, right? And what if you had 20 people with 20 different experiences? You can't just change those terms all the time. So that's where experience comes in to do that. And actually, there's some ways I can help you out with that. I'm good with structuring. There's ways you could do that too. But again, it's something that is learned. It's developed over the years. And I love raising capital. It is fun. I love coaching people on it. I have experiences, good investors, bad investors. The market changes at the end of the day. I'm telling them market changes. Be transparent. Have those communications up front. Put yourself out there. You can't be shy with this stuff. You have to be confident. If you're confident, you'll put yourself out there. So my number one thing to raise capital successfully is confidence. You have to have the confidence in yourself, right? That's the most important thing. Number two could be like, hey, they're buying from you. They're not buying from your product. They're buying from you. And then you got to ask yourself, like, if you can't raise capital, what is it? Something. It's you. It's not your product. It's you. Because if you had your shit together, you'd sell the right product, right? So it always comes back to you. You have to do that self-analysis. So, I could go on and on and on and on and on about this stuff. I'm teaching people how to raise capital. I have a lot of videos on this. If you want to learn more, DM the word capital to me. My name's Craig Cecilio, CXC. Love to share what I learned with you. DN Capital, reach out to me today.